Where have we been, Keith? It's August 6th. I don't remember the last time we did the show. It was at least 2 weeks ago, maybe 3.
Exactly. In fact, you've got married since then. That's how long ago it was.
Yeah, I'm version 2.0 of myself.
Probably 5.0 if you're truthful.
Well, 2.0, I think, is my second marriage. I don't think I'm going to get married 5 times. And this whole issue of 2.0 and 3.0 are the headlines in your news. We're now at venture capital 3.0. I have to say that anytime anyone uses the term 3.0, what it says to me is they have no idea of either what they're talking about or no notion of describing something beyond just 3.0. So 2.0 is legitimate, but 3.0, what's going on with venture capital?
Well, we all know I don't know what I'm talking about, so that's a given.
Well, that's given, right? Nor do I.
Given. If you're listening to this show, we don't know what we're talking about, but that therein lies the mystery and the enjoyment, of course. So what is happening, you can go to thatwastheweek.com and read this for yourself. But this week, a very well-known venture capitalist, Sam Lessin, who is the husband of Jessica Lessin, who runs a very popular news site called The Information. He published a piece, and his piece is basically "The End of Venture Capital as We Know It" is the title. And what Sam argues is that he must have been reading and listening to us, Andrew, because he argues that the impact of the late stage venture investors like Tiger Global and SoftBank on the venture ecosystem is so overwhelming and so large that it is impossible for a small fund to be a venture capitalist anymore and invest in either software or the internet. And his advice is they either have to get big, really big, which he thinks is impossible, or they have to move their investing focus away from software and the internet to more, let's call it niche or harder to predict investments like biotech and AI. And so he's basically waving the white flag in the face of the big guys on early stage venture investing into software. And I decided I really like Sam's grasp of what's going on. Firstly, I think he's exactly characterized what's going on, and it's stuff we've been talking about. What I didn't like was his remedy. And I put forward a different remedy, which is that there's another trend which is as important as the trends he identifies, and that is the trend to more and more sophisticated seed investors investing in more and more companies, a large number of which become unicorns. To give you an example, Silicon Valley Angel, Ron Conway's fund, has 865 companies that it's invested in. 85 of them became unicorns. And now, looking forward, Silicon Valley Angel has 42 companies it's invested in the last few years. According to my data, 4 of those 42 will become unicorns and 38 won't. So my advice to Sam was, instead of abandoning, deep dive into seed investing and try and figure out where the buried treasure is, because it is there. That's roughly it.
So do you think Sam has failed? I mean, as an investor, you say he made all his money at Facebook. So, I mean, a lot of these so-called investors are just guys like him who got lucky by being in the right place at the right time. Has he earned his spurs as an investor?
Well, if you read his stuff, he's clearly a very thoughtful person.
Well, so what? You and I are thoughtful. It doesn't make us investors, or I said it doesn't make me an investor. It's neither here nor there. I mean, a lot of these people just have a lot of money, so they think they're investors. But Ron Conway is a genius. He's been doing it for 25 years?
He's been doing it for a long time. I don't know if Ron would self-characterize as a genius, but he's clearly a very clever guy.
The thing with Conway is he seems a bit stupid, and he's so successful, which means not only is he really smart, but he's very good at disguising his intelligence.
He's Columbo, is what you're saying.
Columbo.
For those younger viewers, check out Columbo. It's a great detective series.
Well, yeah, I don't know if
But
he's
no, but
Columbo, but he's certainly someone who is not a flashy personality, and yet he continues. I didn't know how successful he was, but he continues to deliver. But it's also because he gets to see all the best deals, right?
well, so Sam Lessin is not just lucky. He created Slow Ventures. Slow Ventures is a seed fund that has to work pretty hard at picking what companies to invest in, and it's got a very good track record. So he's gone. He learned a lot at Facebook, I'm sure, and we all start. I think my life at least is you start stupid, you make mistakes, you might
And
get
then you
lucky,
become even stupider.
and well, different mistakes. But anything is learned from doing it wrong the first time,
Yeah.
and so we shouldn't any of us
Do you
degrade
think
people.
it's like football, Keith? Our passion to be a great manager. Do you think it's helpful to be a rather ordinary player? Look at your great hero, Sir Alex Ferguson, or Mourinho. They weren't very good players. The great players don't turn out to be generally very good managers. Do you think
Yeah, I
that's
think that's
true of entrepreneurs and investors as well? I mean, who are the legendary investors?
the legendary investors are few and far between.
Moritz
Uh,
is one, right? He
Morris was
wasn't a
one, and
successful entrepreneur,
he was a journalist.
right? There's still hope
Um,
for me.
so Roelof Botha, who's now at Sequoia, was a CFO.
Yeah.
Reid Hoffman was a founder twice, three times. So
Well,
there are,
Hoffman seems to be, he breaks the rules. He's good at everything,
yeah,
irritatingly good at everything.
yeah, he is. But I think you've just got to have a nose for people and history. You've got to know, you've got to have your finger on the pulse of history, and not be too far ahead. And you've got to understand people, and you've got to think conceptually or abstractly. You can't be too tactical. Those are the things that make
But
good
do you have to be
investors.
counterintuitive? Are the great investors the people who think against the crowd? Because VCs have the reputation, or had the reputation, of all being sheep, of following each other.
Yeah, but that's the bad ones. The bad ones follow the good ones, and it's thematic. Bad investors say, "I want to see traction, and I'm only going to invest in AI." That's kind of a formula-based investing.
So coming back to venture capital 3.0, really, you're suggesting there isn't even a 2.0. Either you know people and you know opportunities and you recognize the uniqueness of history, or you don't.
Well, venture capital 3.0, funnily enough, is as Sam said, the death of what we have formerly known as venture capital. But it's only true if you acknowledge that venture capital has now become three asset classes, and one of them isn't going to survive.
Well,
We've
it's at the
talked about
middle
it a
one.
lot. The
Yeah.
middle
So
one isn't
it's,
going to survive.
but it's like that's what the digital revolution is doing. It creates a high end, a low end, and destroys everything in between.
Correct. And that is what's happening. The big guys are moving backwards into the middle, and the smaller guys, insofar as they're successful, are moving forwards into the middle, and there's less and less space in the middle. There used to be
What is this? What impact does this have on I mean, the people who are funding SoftBank and Tiger, the people at the funds, how is their thinking changing here?
Well, they're very happy because a pension fund basically needs to make something like 1% annual returns on its money or less. And a venture fund, even done badly at scale, like SoftBank and Tiger, will return 3 times your money.
Are they doing bad? Are you saying they're bad at it? SoftBank and Tiger?
Well, because of the large amounts of money they put to work, they can't do much better than 3 times their money. It's the law of big numbers gets in the way.
But what about the pension funds who were putting money into the middle guys, the Andreessens, the Sequoias of the world?
So yeah, there's an article in the newsletter this week about who are the LPs, and that stands for limited partner. And a limited partner is a person that gives money to venture capitalists to manage and turn into more money. They have evolved over the time, just the same as venture has evolved. So if you go way back to the early 2000s, LPs only wanted to invest in the Silicon Valley brand name funds. Those funds became oversubscribed very quickly. These days, really savvy family offices, which is one class of limited partners, invest in the best seed fund managers. But those are risky investments because each seed fund manager is a small investor with less than 100 million and probably only has between 1 and 3 winners and lots of losers.
And it takes years. I mean, it takes 5 to 10 years.
It takes 5 to 10 years. So that's the weird contradiction here. You have the creation of more value than the world has ever seen in Silicon Valley, but most of it is illiquid. It'll shock you, but out of 277 unicorns for so far this year, only one has exited. So your money
Which
is
one's
locked
that?
up. I don't remember which one it is, to be honest. I just
When you say exited, you mean done an IPO?
When an IPO had been acquired. The rest
so
you have to
Robinhood isn't one?
You have to go back to about 2015 unicorns to find where more than 30 have exited out of the batch. So unicorns are essentially illiquid. LPs have money in funds which are illiquid. They have a notional value based off of the value of the companies, but they can't cash it in. So actually venture capital 3.0 is going to fix that. It's going to be possible for illiquid investments to have something close to an index fund approach, where you can buy and sell the index fund, even though the underlying assets.
So this means the VCs doing IPOs themselves.
Yes, and that's happening, as we've talked about.
And what about the Andreessens and the Sequoias of the world? Are they really going away? Can't some of them go up to the first division?
They are doing. Those names you just mentioned they're taking Sam's advice of getting big, and they probably can. The ones in the middle, people like True Ventures or First Round Capital or Spark, who are really good, by the way, at what they do, probably are the most affected by this squeezing effect. They just have to get better at what they do to survive. They'll still do okay, I think, but there'll be less of them. And then on what I call the left-hand side, the seed stage, most money is lost. So it's really about leveraging AI and data to find the buried treasure amongst the sunken ships.
And what about the maverick middle range players, the Tim Drapers of the world? Every time I read one of his tweets, it sounds like he's hit the jackpot, but I assume he only writes about winning. Is there still a role for people like Draper, who are always counterintuitive, always pioneering crazy ideas, some of which happen, most of which don't?
Yeah, I mean, in a way, that's my point in the editorial. There is a place for people who are really good at finding the next generation of software and internet and everything else. And Tim Draper, even though he has a big personality, he's actually got a track record of being very good at doing that. He is good at doing that. So I would say Sam's giving up too early, unless what he means is he's going to move from the middle to the left-hand side.
Well, I have a suggestion, Sam. If you're watching, give your money to Keith because he never loses. Venture Capital 3.0 in the newsletter, Keith, is mirrored by another 3.0, Internet 3.0. This is something, I don't know if Tim Draper actually uses this term, but he's been banging on about this new internet web, this distributed, networked P2P infrastructure. Is Draper one of its visionaries, pioneers, Keith, Internet 3.0?
He's definitely one of the big believers. He's been championing crypto and Bitcoin for years, and he's put his money where his mouth is. Actually, when Mount Gox crashed and the Bitcoin was retrieved by the government, he was the buyer of the retrieved Bitcoin. So he's been in the game a long time and is a believer. Internet 3.0 really describes what Sam says doesn't exist. It's the next version of the internet and software. And what it really amounts to is the automation of trust. If you think of the world that we live in today, trust is human. Banks, insurance companies, and so on, in the business of trust, massive organizations that earn a lot of money simply by being in the middle. And the blockchain developments and crypto put all of that trust into automated code that you can trust because you can read it, you can see what it does. And just as in the real world, there are bad guys who do bank robberies or either mafia or money launderers, there's bad guys in this trustless world as well. But that really doesn't detract from the overall reinvention of the middle as automated software.
And this sort of, in bureaucratic or in terms, is known as the sort of the world of the DAO, right? The distributed autonomous organization. The world is going blockchain in every sense, at least in your view. This is what Internet 3.0 is about. Well, what's the business model of Internet 3.0? We know that the business model of Internet 2.0 proved to be a very problematic one, the advertising model, and which led to the growth of surveillance capitalism. What's the business model of 3.0?
Well, so let's use an example of something called IPFS, which is the Interplanetary File System, it stands for.
I know those guys, yeah.
Right. So IPFS is a protocol for taking a file, breaking it into small bits, and storing it on lots of servers. And because the file doesn't exist, it's pretty safe. And the way it works is, in order to put a file onto the internet using IPFS, you have to buy their token called Filecoin, and you pay in Filecoin. So when you pay in Filecoin, you buy it for your dollars. They get the dollars, but also their token appreciates in value through use. And so the protocol IPFS gets paid for through usage directly in the protocol. Now, that's very different than, say, go back 2 decades to a TCP/IP invented by Bob Kahn and Vint Cerf. There, the protocol was invented. It existed in documents called white papers. And I had to build an ISP to implement it, a private company. And I charged subscription fees to people who wanted to use TCP.
But that was Web 1.0. That wasn't Web 2.0.
That was Web 1.0. In Web 2.0, I created a cloud storage on top of that and charged you a subscription fee for putting your files in my cloud.
But that wasn't really Web 2.0 either. That was Web 1.0.
No, it was both.
I mean, Web 2.0 is giving it away for free and charging on advertising.
No, Web 2.0 is also subscriber-based and usage-based, like SaaS is Web 2.0.
But I mean, the Web 2.0 revolution was driven by Google and Facebook. I mean, platforms that.
Now, what I don't get about. Wait. Let me just say the last bit because we'll lose it. Web 3.0 or Internet 3.0, the need for a private company goes away. You don't need to have a corporation that owns something. What happens is the network runs protocols. Lots of people get involved in agreeing to do that using open source software, and they get paid for using it. And there's no company in the mix. Like, there isn't an Ethereum company or a Bitcoin company or a Filecoin company that is owning and controlling everything.
You've been reading German ideology again, Keith. I don't buy it. I mean, it sounds great in theory, but in practice, even the blockchain, Bitcoin stuff, it's all very well being distributed. There's only a tiny group of people getting rich and people driving these manias. So I just don't buy I understand the technological infrastructure being distributed, but the power, the money isn't. And as you say, given your own interest in VCs, alongside the appearance of DAO and Web 3.0 or whatever you want to call it, the appearance of companies like Tiger and SoftBank, who are increasingly monopolizing the entire economy. So it's certainly not the utopia that some people present.
Well, it's a moment in time, and you're quite right. There isn't a single trend. There's lots of trends. So the issue then becomes which one is valid for the future and likely to survive. And I don't think we know the answer to that yet, but I'm betting a lot on Internet 3.0 being more enduring than SoftBank or Tiger Global, for that matter.
Interesting. Well, I hope we'll come back to that. Apple's in the news. I don't know whether we would call them a Web 1.0 or 2.0 company, but they're certainly in the business of watching us. Lots of controversy about Apple, in your words, Keith, crossing the privacy line. What are Apple doing?
So I think by today, most people who are following tech will know about this. But Apple has announced that in version 15 of its iOS software running on your iPhone, they will have a kind of a artificial intelligence algorithm that can look at every photo and everyone you use in messages, but everyone you store, and it can compare that photo using something called a hash to a database of child porn photos in the cloud. And over a certain threshold of positives, it can report you to the state as possibly a pedophile or whatever. Now, the reason this is interesting is Apple has been going on at great length about how social media is invasion of privacy and how Apple isn't. And this is the first time I think they've done something that threatens to undermine that narrative, because even though the algorithm runs on your phone, it's connected to a surveillance and reporting service to the government, something the Chinese would be proud of. And I think they've probably miscalculated here. I think the pushback is going to be far more formidable than they anticipate.
What about technologically? In your view, at least, is this the kind of thing that can lead to all sorts of unfortunate misunderstandings, people sending photos of their children in the bath and being then reported to the state for being pedophiles?
Yeah. That happened to me and Jenny with a physical photo that we got developed at an agency when our oldest son was less than 1. And they flagged it because it was a child in a bath. And so I think that's part of the kind of paranoia that we live in, where everybody's potentially a bad actor, leads to surveillance, which leads to false positives. That there's no doubt that will happen. But
yeah, I'm surprised that Apple have published. I mean, even if they were doing it, I'm amazed that did they come out with an announcement, or is this?
Yeah, they announced the tech. It was a white paper, quite hard to read unless you're a mathematician. So it was a technical announcement of a future feature.
And then speaking of China, China's back in the news, Keith, another lurch towards digital authoritarianism in China.
Yeah, actually, I find this one interesting because, what's happening here is...
Well, I hope you find all of this interesting. It's your newsletter.
Yeah. So, look, China clearly has produced some fantastic tech and entrepreneurs that have built very, very large, valuable companies like Alibaba, Tencent, and the rest. And what's happened in the last 6 months, and we've been kind of skirting around the edges of it, is the Chinese government has been doing things which make life very hard for those companies. And it wasn't totally clear why. I was actually a little bit puzzled, because you would think it would be good for China to have globally successful footprints built by entrepreneurs. What is happening inside China is that, partly due to the American boycott and the aggression towards China, China's become a lot more defensive and protective of itself. And President Xi has basically started a campaign to emphasize the progressive aspects of communism against capitalism, ruthless capitalism. So very like the US government, he's cracking down on software apps that invade the privacy of Chinese citizens. He's cracking down on financial services apps that perhaps put citizens' money at risk. So if he was American doing the same thing against American companies, he'd be in the Democratic Party and be a champion of the FTC's new lead. So what he's doing is basically socially very similar to what the Democrats want to do here with social media. And it's driven, according to this article in Bloomberg, by a recommitment to, in quotes, communist ideology, which really isn't communist. It's more like social welfare socialism, and emphasizing that the state is in control, not the entrepreneurs.
So is this, in your view, is this likely to strengthen or weaken the Chinese regime? Is this going to be the first crack, or does this mean that China is actually stronger in contrast with America, because whatever American politicians want to do, they can't crack down on the billionaires?
Yeah. Well, I think China will be more successful than the Biden administration in actually damaging these companies and getting back control over things like education in the classroom being done by qualified teachers as opposed to private industry scholar platforms. So I think they'll be successful because the state has enough power and an ability to move fast, irrespective of legislation that the US government doesn't have. Will it be a good thing for China? I doubt it. I think China's future is in being a global example of a more modern capitalism. And I anticipate that ultimately if that doesn't happen, it's going to become very authoritarian. And I don't suspect that will happen.
Well, it's already very authoritarian, especially when it comes to ethnic policy.
It'll become more authoritarian unless it releases capitalism. And I think releasing capitalism actually will lead to wealth and social equality more than any other thing is likely to. I think here in the US, on the other hand, the Democrats will look with a little bit of jealousy on how good the Chinese government is at doing what they'd like to do here with Facebook and Google and the like.
So maybe Lina Khan is a Chinese agent, Keith.
She's
your
certainly
favorite woman in DC.
She'll certainly become a China lover.
Well, I think that's a bit unkind. Startup of the week, one of my favorite features on the show. What's the startup this week?
The startup of the week is the latest stonk. I actually don't know what stonk stands for. Do you?
I think it means something that stinks, or maybe something that stonks on you, that smashes everything, that's very successful.
I think it's a hybrid that means a stock that is subject to rising due to being a meme. And
it is an internet 3.0. It's the quintessential 3.0 company, isn't it?
It is, because it basically millions and millions. Robinhood has 10 times more accounts trading stocks than any rival. And it's mainly people like my children. And
so your kids are they buying the stock?
They're not. They're buyers of cryptocurrencies mainly, but they use Robinhood to do it.
And is the reason why Robinhood had this sort of rather choppy launch is because the institutional investors were wary, and then people like your kids started buying the stock when they could?
Correct. And that was driven by, in social media, the mentions of Robinhood stock went up, I think it was 10 times in 24 hours. And the stock price followed. It went from, 38, which was down by 10% or just less than 10% from its opening price, up to nearly $80 and then settled back down. Last time I looked at 62. Let's have a look now and see where it is. Yes, folks, we can do this in real time. It's now at 55, so it's settled down.
Who is Robinhood challenging? The banks, the brokers? Where's their competition?
Their competition is for taking orders for stock purchases and sales. So it's people like Charles Schwab, it's people like E-Trade, but it's also your high street bank.
Their business model is, I've never really understood their business model.
Is
it sort of an AI-based model?
No, it's lead gen. Basically, they don't settle trades. When you say to Robinhood, I want to buy Tesla stock, they sell your trade to a fulfillment company that pays them for a flat fee for the trade. So they get paid per trade, no matter what the trade is.
And then the fulfillment company, then goes to pester me to buy more stuff?
No, the fulfillment company actually is just doing it. They make money between the buy price and the sell price. So basically, Robinhood's interest is in volume, which is what the critique would be. You know, Robinhood just wants you to buy and sell. It doesn't matter what you buy and sell, because it gets paid for buying and selling. Whereas, you know, the guys who fulfill, they get paid on the difference between the quoted sell price and the buy price. And then, you know, there's a whole value chain underneath that. So Robinhood has got a fixed price, volume based play, which is kind of attractive in that world.
So basically, Robinhood allows kids like your sons to trade for free. They don't charge any commission.
They don't charge any commission, but my kids are paying. They're paying the delta between the buy price and the sell price, part of which gets paid
Although
to
they don't
Robinhood.
understand that, right?
No, no.
So at a certain point, this thing's going to crash, isn't it, Keith? Isn't this a tulip mania? Has to be.
It won't crash as long as large numbers of young people believe that the asset class of stock, shares, and
But
crypto.
that's like saying in 1999 that as long as all the cab drivers in San Francisco continue to buy Yahoo stock, it won't crash. At a certain point, it will.
Well, I don't think if stocks and shares crash, then capitalism would have crashed.
Well, crash doesn't mean go to zero, but you know, the stocks that are being traded on Robinhood increasingly are these bizarre, counterintuitive ones, right?
Well, that's a subset, yeah, for sure. But remember, Robinhood makes money on any transaction. So if there's a crash and everyone sells, Robinhood makes money. If there's a boom,
do you use Robinhood? Do you use Robinhood?
I don't know. I've
Why?
got because I've had an E-Trade account forever and it's free as well.
So why would you use Robinhood if you can use E-Trade for free?
Robinhood lets you buy fractional shares of stocks. You don't need to have as much money to play. So it'll aggregate together 10 people that want to buy a stock, buy the stock, and each of the 10 people own a tenth of the stock. Therefore, if you've only got $100 to invest, you still can get into big stocks.
I'd be interested. Do you know, are there metrics on the typical Robinhood user?
There are. They were in the newsletter a few weeks ago, but it skews to the long tail, as you'd expect.
Well, more, I'm sure, will come of Robinhood. We know that Robinhood, the myth of Robinhood, like all myths, was a lie. There never was a Robinhood, and if there was, he probably was stealing from the poor.
There is a Sherwood Forest, though, Andrew, and I read in the British newspapers this week that apparently it's full of male nudists these days.
Ooh, maybe they're probably Robinhood investor users as well. But finally, the tweet of the week about a company that actually is much more conventional, I think, than Robinhood, much more down to earth.
Yep, this is Hopin. Hopin, we've heard about it a few times. They've done a new round of financing.
A real software company with a real product. Nothing weird about them, right?
Except the valuation is at 7.75 billion, and I'd be shocked if their revenue is more than 100 million. So they're getting 75 times their revenue.
Yeah, I would have thought that in these late COVID times, they wouldn't be doing an IPO. I would think now their IPO opportunity, their window would have been this time last year.
Well, what they're going to have to do now is use this money to grow into the valuation more aligned with the multiples that the public markets will give them, which is about half of this. So that can happen. I mean, a year.
And what do they do, Hopin? It's virtual events, right?
Yeah, they would host us doing this, but they'd allow an audience.
Yeah.
And we could interact with the audience mainly via chat or in breakout rooms. The next stage of this, which Dolby made some announcements about this week, is where the audience can become participants with us just by us picking them, like putting their hands up.
So another sort of a clubhouse version, really.
Video clubhouse, yeah, which Mark Cuban's Fireside announced this week. They've added video to their clubhouse clone.
Are any of these going to be winners? Well, can Hopin become the big winner in this space, or is this even a space, Keith?
No, it is a space. It's virtual events. Think of it as virtual events. Everything from webinars.
Which is live, right? It's everything online.
everything online. They can definitely be a winner.
So I could see Facebook or one of the other heavy hitters coming in, or even Twitter, and buying these people.
Yeah, Reshma Sohoni and Carlos, who run Seed Camp, have a very good track record now. This is the latest win for them. I should say that my fund ADV that I still own shares in is an investor in Seed Camp, and via that in Hopin, which makes them very happy, I'm sure. So, this thing isn't going away. It's for real now. And now the question is, how fast can it grow into the revenue structure that justifies the valuation?
Is the internet going away, Keith?
The internet, Sam Lessin, is not going away, but it's changing.
Well, that's Keith's wisdom. Sam Lessin believes it's going away, or at least the venture side of it's going away. But Keith disagrees. That was the week for August the 6th, 2021. Lots of good stuff. Apple, Internet 3.0, Venture 3.0. I'll do this next week as long as, Keith, we don't mention any 4.0s. Do you promise?
I think the only 4.0 is likely to be non-tech related.
Good. Well, I'm not going to have a fourth wife. I've got a second one, and that's it for me. That was the week, Keith, of August 6th. Keep well. Talk to you next week. Thanks, everyone.
Thank you. Bye.